So the RBA has done it. They've put interest rates up 25 basis points, and this was pretty much as expected over the past few weeks, given the data that had come out. Just a little bit of context before we go into this statement, sort of where we are and where we've been and where we're going. The RBA paused towards the middle of the year, and they said, we're going to wait and see where the data is. And they've been very data dependent. The data has actually come out over the past few months and showed that the Australian economy is quite resilient. I'm going to talk about housing, and I'm going to talk about inflation and retail and the consumer. But overall, they wanted to see what the data would say. The data's come out, and now they have to react to it. Every central bank has its credibility on the line at the moment. They have to follow through with what they say. And it was very difficult for the RBA not to put rates up at this meeting in November, given the data and given where the economy is. Now, the single most important thing for me and other property investors in this statement is these two lines, but particularly the last line. Conditions in the labour market have eased, but they remain tight. Jobs remain very, very strong. The unemployment rate has not increased as much as what the RBA thought it would, given the extent of the interest rate increases over the past 2 years. And perhaps more importantly, house prices are continuing to rise across the country, full stop. Now, this is very, very important because the RBA had been quite worried that given the amount of fixed loans that were maturing, given the nature of the Australian real estate market, given the way that property investors borrow in Australia, that there could have been a lagging effect that would slow down the property market. That fear is almost completely off the table. The RBA is not even hinting at worrying about that. In fact, they've said house prices are rising, and they've just stopped it there. So this is really important for property investors because while interest rates are rising, and they're rising more than expected, they're rising for very good reasons. And they're rising because jobs remain ultra strong. The jobs market's weakened a little bit, but not by much. The demand for labor is still very high. And that is why the housing market has been very, very resilient this year. Jobs drive real estate, and that's the key takeout. For that reason, I actually think that this 25 basis point rise doesn't impact the property market too much. Sure, it slows it down, but it doesn't derail it. And I actually think that the RBA has another 25 basis point increase up its sleeve. I'm going to show why. And I think the market will absorb that. Now, I don't think they move again in December. January, they're off. I think the next 25 basis point rise comes early next year if it's the status quo. If the jobs market remains strong, inflation sticky, coming down a little bit, but not by a lot. And I think even if that happens next year, the market can absorb it. The rest of this statement is the usual stuff. I'll let you guys read it. But I want to go to what's happening on the inflation front. Inflation's been coming down. It's been trending down. But the last quarterly read was very difficult for the RBA to walk away from. The 1.2% rate, market consensus estimates were about 0.9. It's not a big increase above market, but it's still heading in the wrong direction. This is what really spooked the RBA. They thought that the trajectory was coming this way, but that last read at 1.2, I think, forced a complete U-turn. And that, coupled with retail sales numbers that came out and blew expectations away. I mean, 0.9%. The market was expecting 0.5. It's a very, very strong retail sales number that came in addition to these inflation numbers. And then on top of that, you've had the jobs market, which is really strong. You've got potentially some more cost pressures coming from overseas, particularly around energy prices. And it doesn't look like inflation is going to disappear anytime soon. So they really had to move because the economy can withstand it. This would have been would have been a big dent to their credibility, particularly a new governor coming out. And at the end of their statements, they were always saying we're data dependent. We're going to move if we need to, and we're going to see where the data is. But if we need to, we'll move. And the data came out, and they had to move based on what we were seeing. And so credibility is number one. And new governor on board, credibility building. The third and most important thing that I'm seeing out there is the banking system is very, very strong. And a strong banking system is a sign of a strong economy. Again, this is all coming back to a very strong underlying economy. Westpac came out this week and it reported a record profit. But beyond that, it showed that the amount of loans that are bad, that are delinquent, that are behind is still at a very, very low and manageable level. We've seen that from NAB. We've seen that from CBA. Okay, there might be a lagging impact, but we are yet to see any financial issues. We are yet to see any systemic issues. And to me, the single most important thing that you should be watching as a property investor is the employment market. And the employment market is still very strong. The employment market has not weakened. The employment market, not just in Australia, but also in the US, in Canada, in certain parts of Europe, more so maybe the UK, the jobs market is very, very tight. And I think we go into 2024 with real estate responding to jobs first, and then driven by interest rates second. But that jobs factor, the fact that people are working, the fact that people are paying off their loans, the fact that the system is withstanding higher interest rates is a big surprise for me. It's probably been the biggest surprise for me as I end this year, just how resilient the global economy has been. And that's a very, very good thing. That's not a bad thing. Nobody wants to pay higher interest rates, but higher interest rates are a sign of a strong economy. And a strong economy is what you want to be investing in. That's what should drive your investments, regardless of what asset class you're investing in. So I think there's another 25 basis points rise. My predictions haven't been perfect this year. I've had some right, some wrong. But I think in this statement, there's no reason why they won't go another 25 basis points. I think they'll probably stop there and they'll wait to see. I think the economy is going to start hurting next year because rate rises are going to constrain and take out a lot from, the family budget. But as long as jobs are there, as long as employment holds up, which I think it will, I think it'll be a perfect balancing act post-pandemic. In hindsight, if we look back, they went way overboard during the pandemic. They cut rates to a level that was ridiculous. They fueled inflation. They created this problem. They're now trying to fix it. And I actually think they're doing a really good job in fixing it. Things are balanced. Sure, things aren't as easy as what they were during the pandemic. But in order to balance everything, I think we go into 2024 in a pretty good position. The type of real estate that you want to be buying has to be real estate that has not only good income today, but the ability to generate good income into the future. You want to be invested in key metro markets. You want to be invested in assets that are going to be putting money in your pocket, not sucking money out of your pocket from a cash flow profile. And you want to be invested in areas where people are going to want to continue living, because real estate is a network asset, and that asset only becomes more and more, that network becomes more and more valuable over time. So focus on the income growth. You're going to need it because your cost of funding is higher. But if you get that right, this is a great environment to be investing in. Happy investing.